Silver right now is 1.189% or 1.19%, let's say. The price of gold is very cheap historically in relation to the price of gold. But when you measure the spread technically, week by week or even day by day, and create a momentum chart of it, you can even see it on the spread chart. You get up above 1.3% by much, and you're going to blow a cork, meaning silver is going to outperform gold vastly. It's going to unleash. If silver went to 2% of the price of gold, again, it's been at 2% 21 of the past 50 years, so it's hardly an excessive thing. And gold were even, just 3,000. Okay, 2% of 3,000, you do the math, okay? An all-time new high.
This silver bull may have an even brighter road ahead than gold. According to analysts at UBS, silver will likely outperform gold over the next 12 months. Octa Broker has studied the daily closing prices of gold and silver from July 1982 to October 2024, and found that the correlation coefficient between the two commodities is around 0.92. In the interview, MichaelOliver likens silver's volatility to that of a wild dog on a leash, closely following gold. He explains how silver often outpaces gold, as seen when silver surged to $32 while gold stabilized above $2,400. Despite recent sharp drops, silver has rebounded, continuing its unpredictable yet upward trend. Since the 1990s, the gold-silver ratio has been highly volatile, fluctuating between 40-1 and 100-1. These variations are often linked to fluctuations in precious metal prices and global economic conditions. Regarding this, Oliver predicts that the silver-gold ratio, which currently sits near 1.2%, could lead to a significant breakout if it reaches 1.3%. Historically, silver has reached at least 2% of gold's price 21 times in the past 50 years, including peaks in 1980 and 2011 when it hit 2% $50. While lagging behind gold's impressive gains, silver shows promise for an upward move if it can break through key resistance levels. The potential for further rate cuts and ongoing global economic uncertainties create a favorable environment for precious metals, with silver potentially positioned to close the gap with gold's performance. Reflecting on market potential, Oliver suggests that if gold rises to $3,200, silver could reach $66, surpassing its previous highs. He believes silver is poised to break out of its current range and move far beyond its historical peaks, driven by strong technical signals and increased investor interest. We present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Silver is what we call a wild dog on a leash. Okay, but it's got a leash, meaning what gold does, silver is going to do. If gold's going up and stays going up, silver is going to go up, despite its seemingly irrational swings. It'll swing ahead of gold and vastly outperform it, and sometimes vastly underperform it. Examples. Gold had this surge in March and April of this year. And by April high, gold was at $2,450. And if you go sideways, April, May, and June, gold basically was capped by that level. Okay. But in April, when gold finally made that peak that led to sideways, silver exploded another handful of dollars and went from below 30 to 32. So there was a different, went up to 32, I think it was. But anyway, there was a further surge by silver while gold sat still. So that was a period where the wild dog on the leash ran ahead of gold. And then, yes, for instance, 2 weeks ago, we had a sharp drop in silver. We had a mild drop in gold. And so the mama market, the one holding the leash, didn't really drop much. But silver, like I'm going to jump off a cliff. Well, we made that low. It was Tuesday a week ago. We put out a report and said, this is a bear trap. Do not pay attention to this day. At that point, we were down, just above 30, I think it was, in the 30s, low 30s. And it had been, above 32 and 33 even. So we'd had a sharp drop there. So again, the leash went the other way. But if you looked over at gold, it was steady. And what happened? Silver's now back up pushing toward 32 now. Okay. So now when we measure the spread of silver versus gold, it's a ratio. We divide the price of silver into gold. And so we get a percent. So silver, if you go back 50 years and plot a bar graph chart, which we did in the weekend report, showing the peak silver to gold spread reading that year, you'll see that in that 50-year period, 21 of those years reached at least 2% level, where silver was 2% of the price of gold. In the 1980 bull market, when silver reached 50, that First time it ever did. It was up to 6.5% of the price of gold. And then it fell back down. And then in the 2011 peak, when silver again reached 50, gold was 1900, silver reached 3+% the price of gold. Silver right now is 1.189% or 1.19%, let's say. The price of gold is very cheap historically in relation to the price of gold. But when you measure the spread technically, week by week or even day by day, and create a momentum chart of it, you can even see it on the spread chart. You get up above 1.3% by much, and you're going to blow a cork, meaning silver is going to outperform gold vastly. It's going to unleash technically. And again, we're just below 1.2% right now. And I think there's enough things just above 1.2 to drive you up to that 1.3+% level and trigger this bigger stuff. But if silver went to 2% of the price of gold, again, it's been at 2% 21 of the past 50 years. So it's hardly an excessive thing. And gold were even, just 3,000. Okay, 2% of 3,000, you do the math, okay? An all-time new high, $60. And I don't think gold's going to 3,000. A lot of people have that as a working target, some major firms. I think gold's going, the next stopping point will be 3,200. And if silver happened to be 2% then, and the spread broke out, and by the way, when that spread breaks out, it is also a signal that the net price action of both metals is about to go vertical. It happened in 1979 to 80 when the spread exploded. Silver exploded. Gold exploded too, but silver led. And it happened in 2010, latter half of 2010, prior to the rush in silver by April of 2011, where it reached $50 again. And we have the same pending situation right now, where if we break that spread out, you don't even have to look at a silver chart or a gold chart anymore. Just assume they're both going to go vertical. Only this time, silver is going to vastly outpace gold. And it's got so much room to do so, to even get back to, quote, what you could call normal levels, that if gold were to go to, for instance, our next level that we think there might be a stumble or a pause is 3,200. Well, if silver reached 2%, we'd be $66.
During the interview, MichaelOliver explained that monetary inflation doesn't necessarily lead to commodity inflation. He points out that during periods like 2000 to 2002 and 2007 to 2009, liquidity moved into safer assets like T-bonds and gold rather than commodities. Regarding the current market trends, Oliver predicts that commodities will follow gold's upward surge, similar to the pattern seen in the 1970s stagflation. Amid this financial turmoil, gold emerged as a powerful hedge against inflation. In 1971, gold was priced at approximately $35 per ounce. By 1980, as inflation peaked, the price of gold had soared to an all-time high of around $850 per ounce, a more than 2,300% increase in less than a decade. This dramatic rise in gold prices highlighted its ability to preserve wealth during periods of high inflation, as those who held gold saw the actual value of their assets increase even as the dollar's value plummeted. Economic patterns tend to repeat over time, and in 2024, the eroding of purchasing power and the high cost of living are also coming back. Some things never go out of fashion, like gold, as an effective way to safeguard against inflation. According to Oliver's recent analysis, Bloomberg's commodity index will rebound alongside gold, and investors are advised to focus on agriculture, energy, and base metal-related stocks for stronger opportunities in the approaching commodity upturn. Let's get back to the interview.
They define inflation as their CPI and all that stuff. And a lot of the components there are commodity related, gasoline prices and so forth. And if you go back through history, you'll see times where monetary inflation doesn't help. Well, for example, from 2000 to 2002 or 2007 to 9, where they inflated like crazy and cut rates like crazy, it didn't help. Investors, portfolio managers decided to move that excess liquidity somewhere where they perceived it to be lower risk, better reward. And at those points in time, it happened to be T-bonds and gold, 2000, 2007. If you look at T-bonds and gold, they started a launch while the stock market rolled over. And the Bloomberg, for example, commodity index doesn't really correlate well historically to gold. So, you think gold follows, quote, commodity inflation. No, that's not the case. Commodity inflation is when certain assets, the liquidity created by central banks, move into commodity-related sectors or commodity assets themselves and cause those prices to rise, as opposed to, let's say, stock prices. Stock prices have boomed for 15 years. Commodities haven't. But in 2020, late 2020, when gold had already doubled between its low in 2015 to mid-2020. Bloomberg Commodity Index had been going down the whole time. And then when gold went into its range-bound situation, remember after the summer high in 2020, it didn't go up anymore. It was trapped. Bloomberg exploded. Well, gold had already done its thing. Now gold has reasserted itself. By our metrics in March, it said, I'm launching for the next major move. Gold then was around 2,000. Silver was just above $25. At that point, in early 2022, when the war began, Ukraine-Russia, in February 2022, late February, in March, April, May of 2022, the commodity markets peaked. They'd already had their run up before that war event, so they like to blame it on the war event. That wasn't it. It was assets moving into the commodity category. But since then, they had a major correction. Bloomberg corrected about 50% of the way back to its bear market low that occurred in 2020. That low was 58. It went from 58 to 140 and then pulled back to around either side of 100 for the last year. Been, nothing, just sideways. Its technicals now look like it's going to reassert itself. And if that's the case, it won't take much upside to demonstrate that, to prove that, at least by our metrics. It's going to be joining gold. Now, one of the last times that occurred in a significant way was the late 70s, during the period of, quote, stagflation. Mm-hmm. That's when gold went from, $100 in summer low of 76, $103, up to $850 by January of 1980, an eightfold move. In that latter part of that move, the Bloomberg and the CRB index exploded with gold. They didn't outpace it, but they followed it. So I think we're about in that same situation right now, where this time around, commodities are actually going to follow gold, though. And it'll be one of the arenas, especially if you're a stock investor. Look at the agricultural-related stocks. Look at energy-related, base metal-related. They don't correlate well to the stock market, which is good. Mm-hmm. And they all look like they're going to be full participants in a commodity upturn here. So it may be a place to, if you want to stay in the stock market, look at those arenas.
Investing in the gold-silver ratio can be an excellent strategy for diversifying your portfolio. A recent report from Capital Economics suggests that silver will lag behind gold as the slowdown in the Chinese economy has negative implications for most metals. Given the high weight of industrial use, it is unlikely that XAG-USD quotes will outperform XAU-USD. With gold and silver showing strong potential, are you positioning your investments to take advantage of the looming commodity upturn? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.